My name is Steve Boisvert and I'm a CPA with Gelman, Rosenberg Freedman. The topic we'll cover today in some detail is the Child and Dependent Tax Credit. There have been some recent changes in the Child Tax Credit, and these changes will capture quite a few additional taxpayers in the January 2018 through December 2025 tax seasons. I want to first give you an indication of the rules prior to January 1st, 2018, and then I'll explain how these rules have changed to your benefit moving forward. So let's jump in. In tax years before 2018 and after 2025, the tax credit allowed for a maximum credit of $1,000 per child and adjusted gross income phase-outs of $110,000 for married filing joint, $75,000 for single, and $55,000 for married filing separate. The three major changes are the amount of the tax credit, the adjusted gross income phase-out, and the refundable amount of the credit. Tax credit amount has changed from $1,000 per child to $2,000 per qualifying child. You may notice I said qualifying child. So what's a qualifying child? Child must be the child of a taxpayer, descendant of the taxpayer's child, such as a grandchild, a brother, sister, stepbrother, stepsister, or a descendant of such relative. They must live more than half the year in the same principal residence as the taxpayer. The child must not have provided more than half their support, not have turned 17, not have filed a joint tax return, must be claimed as a dependent on the taxpayer's return that year. The child must be a U.S. citizen, U.S. national, or U.S. resident alien for the tax year the credit is claimed, and the child must have a valid tax ID number, such as a social. And this is really to prevent fraud. Now, 2 and 6 are interesting. You'll see these a lot in divorce situations. So in this case, must live more than half the year in the same principal residence. If you are claiming the child as your dependent, and you also want to get the child tax credit, the child must have lived in your house for more than half the year. Six is similar. The child must have been claimed as a dependent on the taxpayer's return. So you can't just have the child for more than half the year. You also have to claim the child as your dependent. This is where if the divorce agreement says one spouse gets the child in even years, well, in those even years, it would make sense for the child to spend more than half the year with that taxpayer. That way that taxpayer can get the child tax credit. If you have one and not the other, you don't get the tax credit. Just something to be mindful of when you're doing the taxes. Turn 17, this is also one that catches people out. In the year the child turns 17, you lose the child tax credit for that child. Now with the new tax law, there is something called the other dependent credit, which we'll get into later, and that's meant to help you out in that situation. So now on to change number 2. With the new tax bill, the old phase-outs changed to a much more favorable phase-out. The Agi phase-out for married taxpayers now starts at $400,000 for married filing joint, and now starts at $200,000 for all other taxpayers. This is up from what you'll recall is $75,000 single, $55,000 married filing separate, and $75,000 head of household. This is also up from $110,000 married filing joint. So it's almost quadruple this number. So if you cross the AGI threshold amount, you'll still get some of the credit, but the credit is reduced by $50 for every $1,000 you're over the AGI threshold. Something to keep in mind. Depending on how many kids you have, you may not get the full credit, but even if you're over $400,000, you could still get a substantial credit. So let's do an example, because that'll probably be helpful to understand the situation. So say we got a married filing joint couple with 2 children, qualifying children, and the AGI of $350,000. Simple math, 2 times 2,000 equals a $4,000 credit. If we imagine your tax liability for that year is $25,000, a dollar for dollar credit of $4,000 has reduced your tax liability to $21,000. That's real savings, and it's basically as good as tax withholding. If we take a married filing joint couple with 2 children and an AGI of $450,000, the math gets a little bit more difficult, but still not too tricky. What we would have is we are over the phase out of $400,000, so we would take 450 minus 400,000 gives us a difference of $50,000. Now you'll recall for every $1,000 we're over the threshold, we reduce the credit by $50. So the $50 times 50 equals $2,500. This is the amount of the credit that has been phased out. If we take 4,000, which was the full credit, minus 2,500, your credit is $1,500. And that is a dollar for dollar credit against your tax liability, which was 25,000 minus 15. Your new tax liability is 23,500. The final piece of the credit to be changed was the refundable amount of the credit. The credit is refundable up to $1,400. And this simply means that to the extent the taxpayer doesn't owe tax, the taxpayer can still receive money back from the government of $1,400 per qualifying child. Now there's various rules to this refundable portion, and we're not going to get into it, but you should be aware that the $1,400 can be limited. And you're not going to see this in a lot of circumstances. You basically have to have no tax liability by the time you get all the way down to the credit calculation. Finally, the last topic worth discussing is the other dependent credit. This is a new credit put in with the Tax Cuts and Jobs Act, other dependent credit. And this credit can be applied to children over the age of 16 who don't provide over half their support. So while they don't qualify for the child tax credit, they may qualify for the other dependent credit, and the taxpayer can receive $500 per qualifying relative. Obviously not as good as $2,000 for a child tax credit, but better than nothing, especially considering that you lost your dependent exemptions with the most recent tax changes. So, is this just for children? No, you can use this for any qualifying relative, and a qualifying relative is a relative that meets the gross income and support tests. So it could be parents, grandparents, step-parents, aunts, uncles, nieces, nephews, certain in-laws, as long as they meet the qualifying relative test, which includes 1, the gross income test, and 2, the support test. So the support test, let's do the gross income test first. The gross income test is in 2018, they can't have made more than $4,150. And this is indexed for inflation, so this could go up over the years, or actually will go up over the years. The support test is that the taxpayer must provide more than half the qualifying relative's support for the year. And support would be things like food, lodging, school, all those things factor in as support. That's all for our topic today. If you have questions or comments, please feel free to reach out to the firm or respond to this blog post. We always welcome your questions. You can email me directly at espoivre@grfcpa.com. You can call me at the firm's number 301-951-9090. My extension is 671. Or feel free to follow us on any of our social networking sites. If you have questions, get in touch. Thanks for listening.